Started with $1 and a dream. This one for all the people that said I couldn't do it.
Good day, Jesus. Thank you so much for making it up to lesson 12. And we believe that this lesson is going to bring you a bit closer to the Chaser strategy. And on this lesson, we'll be looking at the triangles. And the topics that we'll cover are: what are symmetrical patterns, difference between ascending and descending triangles, how to identify triangle, how to enter trade, stop loss and target place, high probability setups. We'll start up now with the first topic. What are symmetrical triangles? Symmetrical triangles usually forms during a trend as a continuation pattern. The pattern contains at least 2 lower lows and 2 lower highs. When these points are connected, the lines converge as they are extended and the symmetrical triangle takes shape. As you can see here, okay, this is an uptrend, moved up, and we say that the pattern contains at least 2 lower lows and 2 lower highs. Here's a lower high and a lower high. Okay, I made a mistake when I said HH, but you do know that it's a lower high and a lower high, and the lower lows and the lower low. Okay. Difference between ascending and descending triangle. Ascending triangle. Test resistance line at least twice and needs to close higher than the previous close. Okay. Price moved upwards, it pushed upwards. Let's say this is an uptrend. Price pushed upwards, came back down, found the resistance at this area. It pushed back upwards, found the resistance again, came back down, created a higher low. You can see here's a higher low, created a higher low to this one here. To this one here. Higher low, it pushed back upwards, found the resistance again, came back down, create a higher low, and then pushed upwards and broke the resistance line. So this pattern is an ascending triangle. When the resistance line is horizontal and the support line is in an upward formation. Okay. Descending line, the same thing happens. Test support line at least twice and needs to close be lower than the previous close, meaning the price came, moved downwards, found support around here, pushed back upwards, came back down, found support at the same area, pushed back upwards, but then it couldn't break the previous low, the previous high, I mean. So it formed a lower high. From the lower high, came back down, found support, went up, formed another lower high, then pushed downwards to break the support line. There's a descending triangle and there's an ascending triangle. Test support line at least twice and needs to close lower than the previous close, meaning that for us to say that it's a valid descending triangle, we have to have 2 points at least that are standing. We have to have 2 points, and then after the 2 points, 2 support points, we'll start looking for the third one or the breakout one. Okay, chasers. Now we're going to take a look at how to identify triangle patterns. Okay, we're gonna study the symmetrical triangle, the ascending and the descending triangle. Okay. So with the symmetrical, we noted that price came up from the downside. We need an established trend. So now in this manner, we're using an uptrend. Price came from the downside, moved upwards, and then it pushed down, up, up. But then in this corrective, this is an impulsive phase, and this is a corrective phase. This phase is corrective. So we study the corrective phase and see what it's telling us. What kind of pattern is it forming? In this manner, you can see there's a high, there's a higher low, there's a lower high, there's a higher low. Can you see that? And then once it breaks your lower high, it shows that we're going to the upside. It continues to go to the upside, meaning that it's the same thing coming from the downside. The same thing will be coming from the downside. It goes up, creates a lower high, goes down, creates a higher low, goes up, creates a lower high, then it breaks to the downside. Can you see that happening? Okay, so you can see it's written symmetrical triangles, support and resistance lines, both diagonal with opposite slopes. Okay, diagonal with opposite slopes. Okay, that's true. And now let's take a look at the ascending triangle. Higher line is horizontal and the lower line is in upward direction. The higher line, the resistance, this is the ascending triangle. So the higher line, meaning the resistance, is in horizontal mode. It's horizontal. The resistance line, it's only testing one specific area. But then the higher lows, your higher lows are in an upward direction. It's forming, how can I put it? It's forming an ascending, it's forming a channel resistance, but then it's forming higher lows, and upward, or an upward trend in the corrective phase. in the corrective phase, because now we'd be looking at the impulse, correction, and then impulse. That's what we're taking a look at. Okay, so you can see price came from the downside, pushed up, came down higher low, couldn't break the high, came down higher low, then eventually broke the high. And for us to say that this is a valid pattern, we have what? 2 points. Here's your first point, here's your second point. So we'll start looking for your entry around the third or the fourth points. Okay. And the descending thing is the same thing as the ascending, vice versa though. Lower line is horizontal and the higher line is with downward direction, meaning that your lower line, your support area is horizontal, but then your resistance area is what? It's in a downward trend. In a downward trend. You can see price came from the upside, pushed down, found support here, pushed back up, lower high. It came down, couldn't break support. So we have 1, 2 points, pushed up, then it created another lower high. Okay? Then it eventually pushed down and broke our lows. So it formed a valid descending triangle. Okay. Now let's take a look at how to enter trades. With the symmetrical pattern, it stated that we enter as soon as the price closes above the previous lower high. You can see it pushed up, down, up, and then as soon as price closes above the previous high, that's when it gives us, it's a confirmation that we're going to continue to the upside. Okay, as soon as price closes above the trend line, it gave a confirmation. To be on the much safer side, we wait for it to close above the previous high or low. Okay, previous high or low, meaning that in low it's when it's vice versa, when it's in a downtrend. Okay, so price would be, it will close somewhere around here above this trend line. It gave us the first confirmation, but then to be on the safer side, the second confirmation would be if it closes above this previous high here. Okay, now with the ascending triangle, it's the same thing, it's the same rule. As soon as price closes above the previous highs, then we enter. Okay, let's see here. Price closes above the previous highs, we place our buy stops. Second entry, price impulses up and gives us a retest, treating previous resistance as support. Okay, okay, you can see it went up, impulse, then it's starting to correct. But then as soon as it closes above this one here, above somewhere around here, it shows that it broke this resistance line. So we're expecting more future moves. So what you can do is you can put a buy stop above the difference, like 3 or 5 pips above the previous candlestick they closed around here. Okay? And the second entry would be something like, let me draw it quick. It would be something like this. The second entry would be something like price impulses all the way up, then comes down, then you go up with it. Can you see that? That would be our second entry. That will be our second. You wait for it to come back down and retest, then you go up. But then this one doesn't happen all the time. So if you only trade that way, you're gonna miss the other opportunities. Okay. Same thing, vice versa with the descending triangle. First entry, price closes below previous low. We place our sell stops, meaning that price came from the upside, support area, lower high, support area, lower high. Went down, closed below the support area. You put your sell stop below it. Close below those areas here. So you put your sell stop below it, hoping for it to do it to go all the way down. Okay. Then the more it goes down, that means you'll be activating, you'll be in the trade. Second entry impulses down and gives us a retest, treating previous support as resistance. We do know of your previous support turning into resistance. So it's also possible with these patterns. Even with the ascending, you do know of the resistance turning into support. So these are also possible. Should look out for them. Okay. Placing stop loss and targets. Okay. Now with the symmetrical triangle, price impulses upwards, comes back down, upwards, down. As soon as we got our confirmations that we're going to the upside, it's continuing on the uptrend. We wait. As soon as we enter, we put our stop loss at the previous higher low, because we know that even if price happens to come back down, it shouldn't break our lows. Ne? It shouldn't break out. This is your higher low, this is your higher low. Mean that if it breaks your low, it's invalid. It's invalid. Give us another type of a pattern or a type of I don't know, maybe a flag or something like that, but then it's invalid. So should put your stop loss just below the breakout lows, meaning that if it broke out somewhere here and you enter here, or you can wait for this entry here, something like this, then when you move up with it, you either have your stop loss here or you have your stop loss here. Can you see that? And yeah, place stop loss below previous low. It's much more safer this way. So you don't need to put it because it might come back, retest here, take you out, and then go up. Can you see that? So you don't have to put it so tight. Just it's much more safer when you're putting it by your previous low. Okay. Place stop loss. Okay, on this one, on the ascending triangles, the same thing. Place stop loss below previous low. Once price impulses upwards, you know for sure that it shouldn't come back down here. Like it's possible that it can do something like this, retest here, then go up. Can you see it? But then it shouldn't come all the way here. That's why you should put your stop loss. That's why you should put your stop loss. So because it means if you, let's say you enter here and then you put your stop loss here, you are likely to be taken out when it does something like this. When it does, or if it creates a weak, like a shooting star somewhere here, shooting star, then you'd be out because your stop loss would be very tight. Can you see this? So give it a bit room. Put it, place it at your previous low. And with the descending one, it's the same thing. Just that the sanya, you put it at your previous high. You saw price pushed down, lower high, it pushed down, lower high, pushed all the way down. So you place your stop loss here, you enter somewhere here, place your stop loss here, you're on the much safer side because you know that if it happens to your stop loss, it shows that it's changing. It's going in the opposite way. Can you see that? Even here, if it does hit your stop loss, let's say you placed it here, it does hit your stop loss, it shows that it's changing. Can you see that? Okay, so we need to be aware of that. Definitely need to be aware of that. Okay, now let's take a look at the target areas. To measure the target, you take it's almost like the same as the recovered previously. You take the distance of the impulse, and now when it's in corrective phase, once it breaks out of the corrective phase, then the same distance is going to be applied all the way up here. Can you see that? So meaning that if it's 100 pips from this high here to the low, this low here, it's 100 pips. As soon as it breaks out from here, it should go all the way 100 pips to the upside. Can you see that? That's how you measure your targets with all these patterns. Even with the ascending, it's the same thing. Your low and your high will be measured as the distance in between here will be measured as target once it breaks out from here. Meaning that if it's 35 pips, 35, okay, 20, let me say 20 pips. Once it breaks out of here, this is definitely guaranteed that it's going to go 20 pips to the upside. It's guaranteed. It can even go way more than that, but then it's guaranteed that it's going to go 20 pips to the upside. Even with the descending one, the distance, like you don't have to complicate yourself with this. You might find out that price is moving like, let's say it done something like, and then it starts to give us something like this. Okay, can you see what pattern is that? Yeah, it gave, okay, this is a double top, not included, but then you take the distance from here, exactly here. Yeah, you don't have to take this one because this is not the low. This is the higher low. It's a higher low, I mean higher high. So you take at the low, exactly at the low, at the starting point of the impulse. Then you wait for it to give us the correction, and then once it breaks out of here, it's the same distance that it went from here to here to the upside. Okay. I believe we saw that. Okay, now we're gonna take a look at it's just a few high probability setups that we need to take a look at. Okay, let's start up with the symmetrical pattern. Let's say price pushed upwards, came back downwards, upwards, downwards like this, upwards. You can see that our pattern is like this. Okay, no, this I drew an ascending type. Let me just remove this because we're starting up with the symmetrical. Okay, sorry about that. Let me just do this quick. Okay. Yeah, just like that. Take a look at the high probability setups, and now we can take advantage of these to reduce our risk. Okay, something like that. Okay. And then let me have this before it broke out here. So what you can do here is but what I'm gonna show you guys is what we call a risk entry. Meaning that if it happens that you are able to spot the pattern that got printed here, you're able to spot the pattern that got printed here. So what you can do is you can wait for it to give us something like a small double bottom. small one, just a tiny one, tiny double bottom, something like this here. Price comes down. Can you see, yeah? And then you take an entry here, entry here. Then when it goes up, you in from here. You can even add another position here. Can you see something like this? But the disadvantage of it is that if it does happen that you get stopped out, you will get stopped out. Can you see it? But then the advantage of it is that your stop loss is going to be placed like when you enter right here with the risk entry, your stop loss will be placed something like this, like 15 pips. 15 pips stop loss, and your target is going to be all the way up. Your target is going to be all the way up. Can you see that? Okay. With a symmetrical pattern, that's how you can have these high probability setups. But now let's take a look at the ones that are like with the ascending type. The type of setup that I like is that, let's see if price happens to, sorry about that, if price happens to push up, and then after pushing up it pushes down. Okay, let me draw it. Okay, it pushes up, then it pushes down, higher low, resistance area, then higher low. Can you see this? Okay, then you'd have something like this. Okay, let me see. Okay, you have something, you have 2 points here, so it's valid to draw. You have 2 points here, it's valid to draw. One thing that I like looking at is that, okay, mostly this area likes to test this. It likes to break at the third touch or the fourth touch. The third touch or the fourth touch. But one thing that you should take a look at is this move that would happen. Yeah, like it would do something like this. Can you see this? And then you can possibly have something like this. And then once it breaks here, you take your risk entry here. Your stop loss would be right here. Then once it breaks again here, once it breaks this resistance area, let's say it breaks it like this, you can either enter here or you can wait for a correction. Then you have 2 entries on this trade. Can you see that? Can you see what happened here? You took a risk entry right here, and you took another entry, a reduced risk entry here. So here it's, instead of, let's say if you're going to get 100 pips, you'd likely get what, 100, 200 to something pips because of the way you're able to capitalize off of one setup. Okay, I like these kind of setups because it reduces our stop loss. We barely take stop losses of like what, 30 pips. Yeah. I like the setup because it reduces our stop loss, and it also gives us high probability. Like it gives us high win rate. Like our win rate is so high because of these setups, because of these kind of setups. You can see that it formed a pattern in a pattern. A pattern in a, we can see this is a ascending pattern. The overall pattern is a ascending pattern, mean that it has to break to the upside, but we're not sure up until it broke, up until it has confirmed. So now what are we looking for? To just take that risk entry, we're looking for any descending type of pattern inside that ascending pattern. So we're looking for a pattern in a pattern, and then from there we're hoping for it to break out that pattern, and then we enter with the bigger time frame. We enter with the bigger pattern, then we are much on the safer side. Okay, these are high probability setups. The same thing applies vice versa with the descending type. Just have to take a look at them, have to master them, and have to just study these patterns. Like study seeing them without even having to draw them. Like the way I can see price pattern nowadays, I don't even have to draw it. I know years of flag, years of, but I do draw it. So it doesn't mean I don't draw it. Okay. Now let's take a look at a few lifetime examples of these patterns. Okay, Jesus. Now we're looking at the dollar index, and we're gonna show you how you can capitalize more on the patterns that we're looking at. Okay. Now you saw that okay, here's an impulsive upwards. I want to show you guys we're starting off with the ascending type. Here's an impulse to the upside. We got the impulse to the upside. Okay. And then let's just take a measurement of it from the low right here to the first. There we go. 624 pips. You saw that, 624 pips. Okay. Then on the shorter time, this is the daily time frame. On the shorter time frame, we're able to spot a very nice ascending type pattern. A very nice one. Can you see here? It formed your higher low, higher low, higher low, higher low. and check the resistance area. It's horizontal. Horizontal, the first, second, third. It broke out at the fourth touch. Can you see? Okay, for fifth, it broke out here at the fifth touch. Let's say the fifth touch. Ne? But there was a way that I was able to capitalize on it before the breakout happened. I saw that the 4 hour time frame, we're going up. We're able to see that we're going up with it. So we dropped down to the 1 hour and then we started seeking for patterns and see what kind of pattern that I found. These are one of the high probability setups that I was showing you guys. See here, I found a pattern in a pattern. A pattern in a pattern. And what pattern is this? This is the symmetrical pattern. Can you see it? Price moved to the upside, formed your higher high, your higher low, your lower high, your higher low. Then it broke to the upside. And check this around and show you guys something quick. The measurement of the target. Right here, 134 pips. As soon as it break out, it went 134 pips. Check this out. Breakout here. Okay, wait, let me do this. I want to show you guys that it pushed 134 pips to the upside. Okay, breakout here. 134. Okay, here's your 134 pips. Somewhere here. Yeah. This was your target area. Can you see that? Okay. And with the bigger one, the 4 hour one, we're still going 600 pips. How much are the 635 pips, say? So we're still going up for 635 pips. You just need to be on the lookout for more patterns that are giving us confirmations to go to the upside. Okay. Just have to look out for more patterns that are giving us confirmations that we're going to the upside. Because check here. Okay, let's measure the 600 pips from current market price. Okay, it's somewhere there at the top. Let me just say daily. So we're able to see that 600 impulse leg from year to year. Isn't it 600? So let's say from, yeah, somewhere here at the previous high. So it makes sense. Can you see that? It's at the previous high. So it shows that we're still going up here. And since this is an uptrend, it proves that we're still going to go up. Can you see this is a nice uptrend? It gave us a nice, beautiful wedge here, but then you get it at the next lessons. And it's still going up. Give us a continuation pattern, then it's still pushing upwards. Okay, can you see this? So you guys saw two patterns here, the ascending pattern and the ascending pattern and the symmetrical pattern. Ne? So the ascending, the stop loss. Okay, let me show you guys the stop losses quick. Because the target, you saw how I measured the target. The stop loss would have been something like here. Can you see it at the previous low here? But since I was able to spot a pattern in a pattern, I'm placing the stop loss of that pattern inside the big pattern. Can you see this? If someone never knew about this, the stop loss are gonna be so far away. But the now one is just here. Check my risk reward of a short-term trade, 202 pips. My stop loss is what, 37 pips. Okay, the risk reward is 1:5. Can you guys see that? Okay, and yeah. And yeah, with the similar, before I forget to show you guys this one here, with the symmetrical pattern, see where I put my stop loss below here, just here by the low, exactly at the low. I put my stop loss there, and as soon as it broke out, we went. It's been in profits, kept on giving us more entries, went up, and now it came back down, and we were able to. Okay, yeah, my stop loss was somewhere here, still stopping it. So yeah, from here on, we're looking for much more entries to the upside. We're still going up here. So we managed to capitalize profits here, and it's still gonna eat. Like one pay is like, it's gonna give us a few more great setups. And we don't treat the US dollar index. Like I don't open buy or sell on the US dollar index. Instead, if I'm buying here, meaning that I'm going on the euro dollar and then I'm shorting. Can you see how we take advantage of these? Okay. And with I saw what GBP order here. I saw it printing a descending type of pattern. We're in a short trade here. It's printing a descending type. Okay, check this out. Here's your lows here. Okay. And check this out. Let me put this here. Okay, can you see what pattern this is? Okay. See what pattern this is. Okay, let's say from all the way up here. Then yeah, it gave us a pattern. It shot down, and see here it said higher, lower high, same support, lower high. So we're expecting a. Can you see this pattern here? This one, the descending pattern. Can you see how easily you spot these patterns? That's how you spot them. And there, we now in a short trade on this pair. Yeah? So we believe that we'll capitalize more. We're still going down, like still going all the way down with it. Okay. And yeah, that's how you capitalize on your ascending patterns and your descending, even your symmetrical patterns. Even your symmetrical patterns, we take a look at them and then we capitalize at them. Okay. Let me take a look at the last one, the very last one. Okay. Yeah, check this out. Took a nice trade here. Price came from the upside all the way down. Then started giving us a nice pattern. Can you see this pattern here? It's a symmetrical pattern. Lower highs, lower high, lower high, higher low, higher low, higher low. It broke out. We're able to capitalize on it. Can you see this out? And it still went all the way down. Let me do this. Check the pips from here to here. Okay. It's at 397. Okay. At the breakout 397. 300 and okay, this 346 pips. 346 still going to continue down because we're looking for a short entry. Okay, it even confirmed. So we're now in a short trade here. Yeah, because I had sell stops. We're now in a short trade here and we're going to capitalize on it. Okay. Thank you so much for paying attention to this lesson, and we're looking forward to having you on our next lesson. Thank you.